The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
We're here and we're going to be talking about money. I have a great guest today who's got a healthy concept. You want to hear what she has to say? We've got a lot to cover today. We're going to start a series on what's wrong with financial planning, and I want to talk about some of the impacts of what happens with inflation. But I want to start by asking you, how much is $1 trillion? You know, we talked today, we've got a debt of almost $20 trillion. We talk about the total net worth of all the population of the United States of being $96.2 trillion. Can you visualize $1 trillion? Can you visualize the number 1 trillion? Well, here's a way to think about that. If you go all the way back to the time when Plato lived, all the way back to that time in Greece, and if you had $1 trillion and you spent $1 million every single day from then until today, you would still have money left over. You would not be able to have spent $1 trillion if by spending $1 million a day from then until now, you would still have money left over. Think about it. That's 7 days a week, 52 weeks a year, and 5,000 years, you'd still have money left over. Think about that. Can you wrap your mind around that? Well, keep that in mind because we're going to talk about $1 trillion later on. $1 trillion is a 1 followed by 12 zeros. You know, if you think of 1,000, it's followed by 3 zeros. A million is followed by 6 zeros. A billion is followed by 9 zeros. $1 trillion is followed by 12. Remember that, because we're going to come back to that concept. But I want to take you back to 1987. I want to start a series. We're going to do a series on what's wrong with financial planning. Financial planning has a big impact. Right now, if you go to almost any financial advisor, they're going to talk about a financial plan for you. They're going to talk about how to plan your financial life into the future. You know, it all started, or pretty much started, back in 1987. Until 1987, the 1987 crash, you know, when the market fell 30% in one day, that had a huge impact on the financial services industry. Prior to 1987, you know, we were stockbrokers. We were not financial advisors or financial consultants. We were stockbrokers because that's what we did. We bought and we sold stock. We bought and we sold bonds. We got paid a commission for doing that. But in 1987, things began to change. At the end of 1987, when the market crashed, revenues for the big brokerage houses took a big drop because no one wanted to buy. People had seen their portfolios drop by 30 or 35%, or even being in bonds, watch their portfolios kind of trickle up. But they'd already come through the high inflationary times of the 70s, and a lot of people didn't like bonds because they'd lost a lot of money in bonds. In 87, we saw the big drop in the stock market, and the revenues had taken a big drop. Most clients had brokerage houses, had multiple accounts at different brokerage houses. And it was Merrill Lynch that came up with the plan. You know, I was at Payne Weber at the time. We came up with an insurance thing where you could put the money in, there was no cost, and it paid 5 or 6 or 7% or whatever it was. And the idea was After a year, when people felt better, their accounts would have grown some. You could move them out of that and put them into stocks. Of course, when things recovered. But Merrill Lynch came up with the idea of the financial plan. And they actually put it out to their financial advisors, who they were now calling financial advisors and not stockbrokers anymore, that they were required to sell one plan a month or one a quarter. I don't remember at this time what it was. And they were charging $295 to do a financial plan. And they wanted them not only to do a financial plan, but a financial plan would give their stockbrokers access to all their clients' accounts. The idea was to consolidate their accounts, to make a financial plan, to put this whole thing together. So if they had accounts at 5 different brokerage houses, they got the information from the other 4 and put them together into a financial plan. And they sold the idea on, this is your financial future, and this is how it's going to do well for you, and we're going to consolidate everything. And then the idea was to go out and convince those clients to move the money they had at other brokerage houses into Merrill Lynch. And it worked well. It worked well. And that became something that then was imitated at Payne Weber, at Morgan Stanley, at Dean Witter. All those firms started to imitate that and introduce financial planning. Today, I don't think there's very many financial advisors who are not also certified financial planners, because that's the way to find out all the money you have and where it is, and to move it in so that they can make their fees and commissions from doing that. So, the concept seemed pretty good to me when I started Adams Financial Concepts in 2005. I'd been 18 years in the big brokerage houses. Hadn't done very much in terms of financial plans, but I went out and I bought the most expensive financial planning software you could buy, Navistar at the time. It was glorified. It was wonderful. Plus, my sales assistant at the time, you could pay $3,800 and send her to a two-week training course, so I did that. So all totaled, I spent somewhere between $10,000 and $15,000 to get all set up. Got set up. We ran our first financial plan. It was wonderful. It had pie charts and line graphs. It had bar charts. It had pages of history. It had all these projections laid out. It had all this information. It was 400 pages long. It had all these colors. Every color of the rainbow was in it. Plus, there were probably twice that number of pictures and colors, and it was really glorious to look at. I was really impressed. Then I began to look at it in some detail, and I realized there's something wrong. I took it home and I went through it page by page, and I was horrified by what I saw. It became the most expensive financial plan that's ever been produced, I believe. It was the only one I ever did. And I presented it to my client, and I said, I don't believe it. I said, this is the most wonderful thing you'll ever see in terms of generated by the computer. The data is not wrong that we put in, but a lot of what it's put out is wrong. So I want to begin with the first thing that I saw was I looked at the projections, the Monte Carlo simulation. And the Monte Carlo simulation is the part of the financial plan that says you have X probability of running out of money when you retire. This is, you might have a 98% chance, or you might have a 100% chance you're not going to run out at all. Or you might have a 50% chance that you're going to run out of money. That's the Monte Carlo simulation. And it was based on a normal curve, what's called the normal curve, the bell-shaped curve. You're familiar with the bell-shaped curve. It's a really nice mathematical thing. I'm a mathematician, and so I grabbed onto this and started looking at this. Now, the bell-shaped curve has an average value, and what makes it really nice is that 67% of the observations fall within one standard deviation. 95 within 2 standard deviations, 99 within 3 standard deviations. And it's really easy to work with. Remember I started the program asking about a trillion? Remember I started talking about how we got into financial planning in 1987? Well, think about that bell-shaped curve. 1 standard deviation, 66% of the observations, 95% for 2 standard deviations, 99 for 3 standard deviations. You know what 1987 was? Away from the mean, 20 standard deviations. 20. You know what number that is? I had to look it up. It is a 1 followed, no, it's a 275 followed by 87 zeros. 1 trillion is 12 zeros. This is 87 zeros. It's an octo-vigen trillion. That's the number. Octo-vigen trillion. Probably the only time you'll ever hear that number in your life. That is the odds of having a drop like 1987. You know what the odds are of having a crash of 2007, 2008? They're 1 in 9,000. Don't forget that. We're coming back. That's the first thing that's wrong with financial planning. More after the break. Don't go away.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm talking about what's wrong with financial planning, a series of radio shows I'm going to do on this. And the first one is talking about Monte Carlo simulation and the use of that bell-shaped curve. And the fact is, you should feel really confident, because if that bell-shaped curve is really true, we should not have another drop like 1987 for an octo-vinitrillion years. Actually, I think that's in days. But anyway, it's 275 with 87 zeros behind it. That's the first thing that's wrong. Is there's no way that you can use Monte Carlo simulation to project how a person's going to come out financially over the long term. There's just no way using a normal distribution. And most people knew that, but they couldn't figure out any other shape of curve to use. And it's a really easy and nice shape of curve to use. So it reminded me of the story of the cop that comes along and sees the drunk under the street lamp. And he says, "What are you doing?" He says, "Looking for my keys." And he said, "Did you drop your keys here?" "No, I dropped them in the alley." "Well, why aren't you looking in the alley?" "Because it's dark in the alley." I mean, it makes no sense. So that's the first thing that's wrong with it. It assumes events are going to be happening on a bell-shaped curve Monte Carlo simulation. But as we came into 2007, 2008, by the way, the odds of having a 20% drop, the odds of having a bear market based on the bell-shaped curve that we have, we should only have a bear market once every 111 years. That's interesting, isn't it? We've had a few bear markets in between on a more often basis than that, but that's the problem with the bell-shaped curve. It assumes that for forecasting, and reports are turned out, not every report is 400 pages long. Mine was extraordinary, but that's the kind of report that people are getting. You know, what happened in 2007, 2008 is a lot of academics realized that the bell-shaped curve didn't work. So they came up with what they called a fat tail curve. So that's being plugged into the financial plans these days. The bell-shaped curve is a special distribution. I'm a mathematician, so all this makes sense to me. Probably doesn't make a bit of sense to you. But it's part of a family of curves that look like that have that upside down U shape. They're called Cauchy distributions. And by extending the ends out, making the U flatter, you get a fatter tail curve. So you can give a 40% greater weight to those events, like happened in 1987, like happened in 2007, 2008. You can give a much higher weight. You can give a 40% weight. You can give a 70% weight. You can give a 20% weight. You can adjust that. And my question is, on what basis? Is it 40% more likely to happen 2007, 2008 than it was with just the normal bell curve? How did they get to that? Well, you figure what 2007, 2008 was like, and you adjust the curve out so that it includes that number, and you say this fits. Well, it fits for that time, but when will it fit another time? I had a summer job at Pacific Gas and Electric back a long time ago. It was just at the time that operations research was really coming into effect. And the function of the department I was in is forecasting electrical demand in Northern California. And the way that it had been done is you would take out last year's forecast, take out that book that had last year's forecast, you'd count out the same number of dividers, and you looked at the pages and you just updated everything. If they would have had Word in those days, it would have been much easier than to have it all typed out and printed out, scratched out, penciled out, inked out, erased. But we didn't have that. But they also wanted to computerize a lot of stuff. And I worked on the computerization of the forecast. And we were building linear regressions. Now, linear regressions are when you say, we have a variable over here and we want to forecast this variable. We have the number of sunny days. We want to forecast how much electricity is used. The hotter the day, the more the electricity. The cooler the day, the less electricity to a certain point, and then you get into cold weather and the more the electricity. That's the concept of a linear regression. And because this was so new, we were tossing in linear regressions which had variables from everything we could think of. And we found a 99% correlation. And what you could almost say is an absolute predictor of electrical power consumption. It worked. It was such a good fit. And I learned from that. I learned a lot from that. You know what the variable was? The number of prisoners on Alcatraz. We'd thrown it in as a joke just to see how it worked. And it had the best correlation of anything we could find. The number of prisoners on Alcatraz forecast electrical consumption precisely for Northern California. Well, if that was really a true correlation, today they wouldn't be consuming any electricity in Northern California. It was an important function, because forecasting electricity is very important, because you're spending a lot of money to build electrical plants. And if you build them too soon, you waste money. If you build them too late, you have brownouts. But forecasting based on the number of prisoners of Alcatraz? No. You have to find cause and effect. You have to have accurate data in. You have to have accurate reasons. The issue with the financial plan is it's not accurate. 2008 proved to be a very difficult time for a lot of investors. There were retirees that had to go back to work. There were retirees that had to cut back on their expenses because of the losses. I know of at least one family whose children were planning to go to a very prestigious school. After 2007, 2008, they couldn't afford it, so they had to go to a less prestigious school. Those things happened all over. People lost houses. All those things happened. All those people had financial plans that had a prediction based on Monte Carlo simulation, based on a normal bell-shaped curve, and they were dead wrong. Dead wrong. Just because it was computer generated, just because it has a lot of pie charts and bar graphs, just because it has a lot of colors, doesn't mean it's right. Reminds me of one more story, and we'll finish this off. When NASA was working on the space station, they realized that ballpoint pens don't write in zero gravity. So they spent millions and millions of dollars to develop a ballpoint pen that did write in zero gravity. You know what the Russians did? They used a pencil. The idea is to keep it simple and straightforward and accurate. That's the first of the series. That's what we try to do at Adams Financial Concepts, by the way. We try to keep it accurate and simple. So I want to introduce my guest today, who's got a great story to tell. Megan LaRiviere.
LaRiviere, yes.
LaRiviere.
Thanks for having me. I'm excited.
From an apple a day. So, Megan, let's start with your background.
Sure, yeah. So I grew up in Yakima, Washington, and Apple a Day is the company that my sister Danielle and I started. And so we were both high school students at the time, and really the concept for the company came when Danielle, my sister, who's a year older than me, needed a summertime job, and I needed one as well. And rather than, going to work for somebody else, we remembered an idea that my dad actually had. He worked in insurance, and he noticed as he was waiting for a client one day a bowl of apples and a refrigerator full of water. And he just kind of thought, why aren't people doing this? Why aren't people offering A, healthy snacks, and B, chilled fruit that actually looks good that people want to eat while they're at work? And so rather than, like I said, getting jobs, we just started what we called Apple a Day, and initially began and went out and cold called businesses in the Yakima area to see if they would want apples delivered potentially, which was, looking back, pretty ironic to sell apples to different businesses in the apple capital of the world, you might say. But that was the initial concept.
And you signed up 30 businesses. Is that right?
We did. We wanted 50, of course. We ended up getting 30, but we were very young entrepreneurs and maybe a little naive to how many businesses might want to do business with us. And so rather than being discouraged, we thought, hey, we'll get a van and we'll just kind of start delivery to these 30 people, these 30 businesses, and see where it goes.
And you've grown from there. We're going to come back and talk about that after the commercial break, and we are going to come up to a commercial break. A lot more to the story, a lot of interesting things to talk about today. So don't go away. We are going to be back right now after the commercial.
About Money with Mike Adams. In a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm here with Megan LaRiviere of Apple a Day. We just got started and talking. We left off with 30 businesses in Yakima taking apples a day. So let's go from there. What happened?
Right. So that was after the first summer. Like I said, my sister and I went out and cold called businesses in Yakima. And we ended up with 30 companies interested in signing up for Apple delivery on a weekly basis to their offices. And so we purchased a van. We were lucky in that we hired a delivery driver to deliver apples to those businesses. And what made our service, I should mention, unique was not that we were just bringing in, a bag of apples and leaving them at your doorstep. Rather, it was a full service in that we have small apple refrigerators that we still have to this day. And the concept behind what the business was when we started was to stock apples on your countertop, but in a small, convenient fridge that kept them cool and crisp all week long. So our service included 3 to 4 different apple varieties. We would come in, clean off our fridge, restock it with 24 apples, and do that week by week. So we had 30 clients that were interested. And from that point on, Danielle and I knew we wanted to go to college, and we weren't, dead set on just starting the company without the education behind it. So we went ahead and both ended up going to WSU. Danielle graduating it with an entrepreneurship degree, and myself with business and Spanish. But the way it worked was that through summertime and during the year, we would send out invoices to those 30 clients and then grow our client base as we were home for the summer and able to, again, make those cold calls and be selling to Yakima and the surrounding areas. We ended up going into the Tri-Cities, selling there, and then that's kind of how it fostered through school. But the great part about WSU was that, we had this company that we were starting and committed to, but we were also exploring kind of other options as well. And my sister Danielle actually met our third partner, Lexi Schmidt, who's now with us today, just through their sorority. And Lexi ended up being really interested in the concept behind being young and an entrepreneur and delivering a healthy product such as what we were doing. So our third partner got involved at WSU, and she actually helped take us to the UW Business Plan competition and various other competitions at the time through different colleges in the area. And Danielle and Lexi spearheaded that and did really well. And so that was kind of the brief start of Apple a Day. And I think things really got rolling once we all three had graduated and realized that we were really serious and ready to make this our full-time jobs rather than just summertime and when we weren't in school.
So now you've moved to Seattle.
Yes.
You do this in Seattle.
Yes. So full disclosure, Danielle and Lexi, again, were 2 years older than me. So they were here a year before I was. In 2012 is when they first had boots on the ground, as we call it, in Seattle. And really not anything other than that. We had no interest in the area. We hadn't even called on anybody in the area. We just knew that on the west side of the state, there's a lot more business and that people were a little more health conscious and definitely had the dollars to open something like this, a healthy fruit delivery service to offices. So that was kind of the idea. Same thing, just new location.
So tell us about what service you provide.
Sure. So now, fast forward to 2018, we are a fresh fruit and healthy snack delivery service for offices. We service...
So not just apples.
Not just apples, yeah. So we finally realized, health is more than just an apple. We need to be offering some other things. And our clients really were interested in other types of fruits. And that's what led us to expand into seasonal fruit. So right now, a typical apple a day delivery would have 4 to 5 different apple varieties, as well as maybe 3 or 4 or 5 seasonal fruit varieties as well. Anything that we grow locally here.
Like seasonal fruit, give me an example of
Sure. So seasonal fruit would be basically any type of fruit you can think of. We try to focus on grab and go type fruit items. So we're not delivering maybe a pineapple to your office, but things like a new variety we have this week is called a Cara orange, which is a mix between a navel orange and a grapefruit, but it includes a number of things. So bananas, oranges, peaches, pears, plums. We try to bring you the best of what's growing locally first, supporting small local family farms, and then in the wintertime, where we're not growing much in the state, we will bring in some things from California and other areas to just kind of give you a variety of the best tasting fruit per the week that you're getting your delivery.
And how do you select the fruit?
So we work with a number of, like I said, small local family farms who will give us recommendations all the time. They know their product best, so they're able to tell us, hey, we've got, these great oranges coming in, or specifically we work with Peterson Fruit is one of our suppliers up in Mukilteo, and those are great guys up there who can really give us some information on what they like, what their clients like, what's coming in that's fresh and new. And then we've also established a relationship with them and other local vendors so they know what our clients like, which are, again, those kind of easy to grab, office friendly type fruits that are going to look really great and leave your office really colorful and entice people to grab them.
So I know that sometimes we buy fruit at a store, and we've just bought a sack of oranges, for example, and a couple oranges were bad. How do you assure that you get only the highest quality fruit?
Yeah, so that's really the biggest benefit to Apple a Day as a service. Anyone can go order Safeway or Amazon delivery and have it dropped off at their door. But what Apple a Day does and what differentiates us is that we hand select, deliver, and stock your fruit straight into your office kitchen or wherever you would like it. So that really is how we're able to control the quality of every piece of fruit that we deliver. Having someone not only open up a box of apples that we get straight from our growers to our warehouse, taste that apple, make sure the quality is there, and then also rather than just giving you that entire box of apples, we go through every single piece of fruit and then place it in a bin that's specific to your order if you're a business working with us. So that means we're looking at the product and tasting it while it comes in. We are stocking it ourselves into our bins, and then we're bringing that straight to your office, hand delivering it into your kitchen, really saving you a lot of time and just not having to deal with the 5 moldy oranges that you've paid for that now you can't eat.
So you get a box of oranges, and you find 1 or 2 or 3 are bad. What do you do?
So if they're really bad, we'll just compost them. If they are a couple nicks and bruises and things that maybe our clients wouldn't like, but that are still edible, we donate all of our fruit to local food banks and charities. So we're not throwing out anything that is good to eat. And then we're sometimes sending stuff back if it's just, the whole box has an issue for whatever reason.
So you will send it back?
We will, to the grower. I mean, just depending on quality. We have minimums and we expect a certain level of quality on newer shipments.
And it delivers us a really good message to the grower.
I guess so, yeah. We may be a little bit of a picky client, but that's because we want the best for our clients and we know what kind of level of quality they expect from us. So we do everything we can to source the right fruit that we need.
And the big stores will get a shipment of product in, of fruit or whatever, and it's just box after box. They don't go through it piece by piece.
Exactly. I mean, that's why our service, getting fruit locally, I think is such a big deal. We also do some healthy snack delivery as well, but the majority of our clients do really find a lot of value in our fruit service for that reason. There's not a lot of companies that are going to go in and hand select every piece of fruit. Frankly, it's a lot of work and effort on our part, but it is why we're in business today. It's our service. It's the product that we focus the most heavily on, and it's why we can time and time again bring you a quality fruit basket, or our apple fridge always has apples that are cool and crisp and going to taste great, is because of that extra level of care, which for produce or any perishable item you really need. I mean, no one wants a bag of really bad navel oranges in their office, what's the point of buying that in general? If you're not going to have quality produce that entices people to eat it, you may as well just not order anything.
So I know there are businesses that also deliver fruit. They'll deliver it to somebody in HR, and somebody in HR has to distribute the product. How do you handle that?
Right. So from a time savings benefit, Apple a Day is huge. I mean, if you're a business owner, you know relatively how much you're paying either your office manager, your HR manager, your operations manager per hour. And you have to ask yourself, do you want them to be spending 3, 4, 5 hours a week going through fruit, or maybe even placing an order for fruit once a week? The little things are what add up in terms of people's time and effectiveness. So Apple a Day is workplace wellness automated. That is why people like our service. They don't have to think about what's best in season. They don't have to think about, oh no, I forgot to place my Monday order and Mondays come and there's no fruit. They don't have to worry about the delivery person that doesn't show up or that's very late. They don't have to worry about, the bag of groceries left on their doorstep, and maybe they're in a meeting, so now they can't get to the delivery and things have kind of baked out in the sun all day. Whatever the case may be, we take all of that off their plate. We leave your office kitchen looking great. It's like we come in, we distribute our fruit, we stock it up, make it look great, and we leave. And a lot of times you don't even know that we've been in your office because we're just quick, efficient, and like I said, automated.
Very good. We're coming to a commercial break. After the commercial break, I'm going to have Megan tell you how to get a hold of her, how you can set it up so you can do the service Apple a Day. So don't go away. You want to hear how to contact her? Take out a pen, write it down. We'll be right back after the commercial break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I'm here, and we've just had a long, interesting interview with Megan LaRiviera. And I wanted her to tell you how you can contact Apple a Day if you want to set up the fruit service. It is superb. I had one of those car apples. Not apples, oranges. Excellent fruit, excellent quality. So Megan, tell people how they can contact you.
Yeah, so the best way to get Apple a Day into your office or just more information would be to go to our website, appleaday.com. It's apple-day.com. From there, we love offering offices free trials of our service. We want to let you try our fruit and our healthy snacks for yourself and see if other people in your office are interested in having that type of a wellness perk. But also healthy@appleaday.com is a great email address. Again, that's healthy@appleaday.com. And a good phone number would be 509-969-4181.
And say the website once more.
It's appleaday.com, apple-a.com.
Okay. Do that because it's well worth the quality, well worth the healthy lifestyle. So I've been talking over the last few weeks, actually I've been talking for years about Dow 100,000. I've been talking about the super cycle, and I said we're in a secular bull market, very similar in many ways to 1982 to 2000, one that lasted for 18 years. And if the super cycle is correct, and I believe it is, we're again in a secular bull market that will see us hit Dow 100,000. And the question is, how does it come to an end? And I talked in the last 2 years about how this will come to an end. I believe it'll come to an end with a bout of high inflation like we experienced in the 60s and 70s. Now, if you look at and log into Investopedia or some of the other sites, they'll say that inflation really began, high inflation and stagflation really began in the 1970s. But if you've been listening to the program, you know that in 1962, inflation was running 1%. By 68, it was 4.2, and by 69, it was 5.5. That, if the market ends with high inflation, there's things that need to be done, and they need to be done over a period of time. But we can gain information from looking historically. And you know that I don't believe that history repeats. I believe that it rhymes. And so I believe that there's a reason to look back at what happened before and to see where things were going. You know, the reality is we set into motion the 1970 high inflation, stagflation. It began in 1961. Inflation was 1%, and it began to creep up. But in 1961, unemployment was 6.7%. By 66, it had shrunk to 3.8%. And by 69, it was at 3.5. You had most of the people at work. And inflation, you know, as a rule of thumb, you can say it's driven 2/3 by wages and 1/3 by commodity prices. And so when you had such a low unemployment rate, you began to get an increase in labor rates. That increase was accelerated because productivity was slowing down. A lot of the same factors you hear about today. Productivity has slowed down. We have 4.1% unemployment rate. You know, it's also commodities at that time. They were relatively stable in the 60s. They just began to rise a little bit in the 70s when oil prices went up. Now, at the time that we started to see inflation pick up, we also started to see a recession happen. From 69 to 70, we started to see the beginning of a recession. By 71, we were into a recession. And in 72 was the election. 72, following that election, Richard Nixon appointed Arthur Burns as chairman of the Federal Reserve. And they were concerned about the recession that was taking place. Arthur Burns, his expertise was in business cycles, and they wanted to put pressure into the economy to make the economy reverse this recession and begin to grow again. And so what they began to do is they began to print money. You know, we did that in 2007, 2008. You remember, we went through the TARP program. We went through the Federal Reserve buying bonds in the open market. We went through the Treasury putting money in, stimulus into the economy. That's what we mean when we say we print money. That money went in. But in 2007, 2008, unemployment was 10%. Capacities had been laying off people, and so they were underutilized. But if you look back in 1969, the employment rate was 3.5%. Labor was really tight. And so by pumping more money into the economy, what that did was actually begin to push up commodity prices, and it began to allow people to raise prices and pay more. The unions were involved. You know, if you look back and people say the reason we got into this whole thing is because of massive deficits supported by the politicians. We went through, under Johnson, we went through the Great Society, we went through the initiation of Medicare, we increased Social Security, we did all those things which had an impact on increasing the deficit, which was financed by pumping more money into the economy, and by these expansionary policies of pushing more money into the economy, we began to get inflation. Now, a lot of people blame the inflation on OPEC because that's when commodity prices really began to increase. But inflation had started back in the early 60s. And the impact of all that, what really matters is the impact of how that happened. Because what happened is purchasing power dropped by 50 to 70%. That meant if you were sitting in cash, that cash would buy 1/3 in 1982 of what it bought in 1969. 1/3. Bonds dropped in value because bonds were based on interest rates. Bonds dropped as much as 70 or 80%. The stock market dropped 40%. Income, people who were living on fixed income, people that had annuities, there weren't many of those, but those annuities bought a whole lot less by 1979 than they did at the beginning of that time. Inflation creeps up. A portfolio should begin to creep up with it. Putting in 5% of gold into a portfolio doesn't do it. 10% gold doesn't do it. Oil probably won't do it. You know, it's a difficult time. Planning for it is a long process. As inflation begins to pick up over the next decade or 15 or 20 years, there's a process that you have to go through to adjust for that. There are things that you can do. It's not an immediate sort of thing that has to be done today. And I expect we're going to see Dow 100,000 before we really see the break and the down of inflation. But I begin to think that today is the day to begin to change portfolios. That's where we are. There'll be more on it because we've got years and years to talk about this. But now is the time to begin to plan for high inflation. A little bit at a time. Do too much, you lose out on the upward returns in the stock market. Do too little, and you end up with a real mess on your hands when the inflation really hits. It's a process. I'll be back next week to talk more about what's wrong with financial planning and the rest of these subjects as well. Join me then.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program sponsored by